I'd like to address the market. It's a niche, and I think it's very important that we say two things about that. One is 15 years ago, I was very interested in doing larger deals, 200 unit apartment buildings, until I started selling those properties in 2016, 2017, and realized that the money that was chasing the larger properties from pension funds and large private equity firms was just very large. They had more cash than they really knew what to do with, and they were overpaying for properties as a result. I had one property we put on the market, 195 units in Sacramento, and we had 11 offers in less than 5 weeks. It was just, they swarmed it. So I sent out best and final letters to the top 5 of those buyers. And the range of cash that was in each of their portfolios was ranging between 30 and $140 million. They just had flat out too much cash and not enough inventory to buy. So I feel they overpaid for the property that I was selling. And it was at that point that I realized that I can't compete against that on the buy side. I'm never going to make bad decisions buying things for the investors. So I shifted, and that was a fascinating moment because there was a strategy coming from a book called Blue Ocean Strategy, a Harvard case study, that just simply identified that if you're in this red sea of shark-infested competitive waters, if you just look up, there's a whole blue ocean of opportunities out there that if you are innovative enough, you can see them. So I made that shift. I decided that the company was going to focus on sub-institutionally sized properties, still apartments, but 5 to 50 units where we're under the radar of those projects that large institutions would be interested or fascinated by. And in that, we can bring our institutional asset management capabilities to a mom and pop environment. And I really enjoyed the possibilities there because we can be presumably the smartest person in the room in that case and still not be considered having insider trading like you would in the securities business, but just simply work harder. So that's what founded the strategy for VisionWise Capital, staying in that niche. That's the first thing, is making sure you have a proper niche. The second most important component is to stay in your lane. Something we've learned over the years when fund managers move from being an income manager, for example, to a growth fund. Very dangerous transition. It's a very different business model, different strategies, different analytics, and that's something that I refuse to do. We stay in our lane. We buy 5 to 50 unit apartment buildings built between 1940 and 2000. They're all B minus, B plus locations and properties, and we know exactly what we're going to do and what we're getting into when we buy them. Staying in your lane reduces risk, increases profitability opportunities. That's what we do. If you look at this, the bigger picture, the property has to have increasable rents. It has to be somehow or another able to either reduce expenses significantly or increase rents to the point of being able to capitalize on that upside. So how we get there is what we measure, and that's different for every property. But I can tell you that we have certain guidelines. So for example, what's marvelous about real estate is that if you can increase the net operating income, then you multiply that increase by 20 times, and that's going to be roughly the value that you've created. It's a very highly leveraged environment, even if you don't have a lot of debt on the property. So what that means for us is we need to make sure that we net, after all of our capital expenditures, make money even on the money that we put in to innovating or renovating the properties the way they need to grow. So as we upgrade the properties, for example, if I put $1 million into the capital expenditures, I need to make sure I get $1,150,000 out in terms of value proposition. I need to have at least a 15% return on the money that I put into the deal. I need to make sure that once we put that money into the deal and have it upgraded, then the property is not going to be something where I'm expecting to get above market valuations on the other end, the exit side of our transaction. That's absurd. I'm not trying to create a market. I'm just trying to operate within it well. So we don't kid ourselves. When we buy a property, if we expect to exit 2 years later, then we add another 25 basis points or 0.25% increase on the expected outcome, the interest rate and the cap rate coming out, to make sure that even if interest rates climb during that time, we're still going to be just fine on the exit. Very conservative structure, very manageable structure. And again, the key thing there is never over 50% loan to value, so that even if you do make a mistake, you don't have a risk of losing the asset to the bank. We are a strong operator with processes and metrics that measure everything. I want to know exactly how many days it takes to turn a 2-bedroom, 2-bath unit from the time we get the keys. I want to know that because every day that we extend the turnaround time in that property or that unit is a day of lost rent. And that means everything, right? Because it's only about income that really matters on an income property. I would say that the family office is very concerned about our operating skills. They want timing, they want the projections to actually be real and actual. Most of them are smart enough that they have to monitor that. So we have weekly phone calls sometimes or conference calls to make sure they stay on top, or monthly financials to make sure they understand and can see how we're spending the money that we raised from them. I think that for the most part, they already know that real estate as an asset class is very powerful because of the tax benefits. For one, they can minimize the tax liability. In fact, we help them do that. We moderate our operating gains and losses so that their Schedule K-1s show up in minimizing their tax liability as best we can. In some cases, cost segregation can accomplish that as well for those longer-term hold assets. They recognize that apartments are a really solid product within that real estate asset class because it's a diverse schedule of income from different units and different tenants. But it also has this ability to recognize that people would prefer to live indoors, and multifamily residential allows that to occur. Much different, much more effective than office, where people don't have to, as we know, show up to work anymore. So multifamily residential is a very powerful product type for family offices. Family offices that we do business with, they recognize, number one, it's the same thing as what I talk about with regards to CCF. They want to make sure that our character allows them not to have to be an operator. Most family offices do not want to operate the deal. They just want to be an investor and have a trustworthy operator that they know is going to do what they say they're going to do. I believe the second thing they want to make sure of is that we're competent. We have a long enough track record now over the last 10 years to demonstrate that, and enough voices that they can speak to that will assure them of that. But I believe that the integrity component of character is what they feel most comfortable about. And then I think location is the next thing, and something that everybody has a chance to really choose. If it's going to be high income, it's going to be something in the Midwest. If it's going to be high growth, it's going to be something on the coasts. And what they recognize is that 50% of the population of this country lives on about 4% of the land mass of this country. It's mostly east and west coast. So if you're going to be in a place where you want high growth, you need high applicant flow, and that's where you need to be someplace where you have a large, high density population. The greatest risk in real estate is really not the real estate. It's actually how you structure the financing of the deal. What I found is that if you structure it properly, then you go through an unexpected downturn. It's called a black swan event in the economy. And when that happens, if you own something all cash, then that real estate's not going to be taken back from you. You can ride it out. If you own something with 80% debt, then in our business, you have about a 17% drop in net operating income before you have a notice of default from the bank. So what I did is I looked at the most recent really deep depression, and that was the Great Recession is called, right? The 2008-2009 timeframe. And I looked to see what the net operating income did on average with Orange County apartments during that season. And there was a drop of about 20% in net operating income across the board. And with that, that would not have sustained an 80% loan because you would have had a notice of default at about a 17% drop off. So what I did is I backed it up and I went from zero debt and climbed 10 points. I got to about 55% loan to value, where the net operating income could drop 32% and still not lose the asset to the bank. I felt very comfortable that if we were going through 2008, 2009, we would have sustained ourselves. We would not have had a loss of assets. When you lose the asset to the bank, by the way, that's not a loss. That's not a recognized loss. That's a realized loss, right? It's gone. Your money's gone. So that's an unacceptable outcome to me. Therefore, we backed off. We found that the give up on the upside is not great enough to justify over leveraging, and came to the conclusion that we're just going to make it a principal at 50% loan to value. I will tell you, to augment that answer, I'd say that during this pandemic of 2020 and this jump in interest rates in 2022, our investors are so thankful that we stuck with that conviction, because we don't have a risk of losing an asset. We've not received not one notice of default from the bank. And in fact, we have lenders now that are very pleased with us and asking if we want to refinance and do another deal with them because of the fact that we're so conservative on our debt level. Colleagues in my industry, they seek as much leverage as they can because they're trying to have great results without as much effort on the buy side to buy it right. And that's the way you do it. If you leverage 80%, then your 20% down payment just simply has a greater growth opportunity on any particular upside. I just find that I'm more protective of the downside risk because I have investors to be a fiduciary towards. And it's not my objective to kill it on a deal. My objective is to be consistent on a deal. And so as we do that, we're able to get double-digit returns without taking the risk of losing the asset to the bank.